What if the next major market crash isn't actually a surprise? What if the warning signs are already sitting right in front of you, hiding in plain sight, and most people are either ignoring them or haven't been shown how to read them? Here's the thing. Every single major crash in the last 50 years left behind a trail of clues before it hit. Not guesses, not gut feelings, but real, repeating patterns that showed up time and time again. And right now, those same patterns are forming again. By the end of this video, you're going to know exactly what the 4 warning signs are, how they played out in history, and what you can actually do to protect yourself before the next one lands. This is not about scaring you out of investing. It's about making sure you're never the person waking up blindsided, wondering what just happened to your financial future. Now, before anything else, one thing needs to be said clearly. Nobody, and I mean nobody, can tell you exactly when a crash will happen. If anyone could, the market would already have priced it in and corrected itself. The US market, and really any market, would lose its entire reason for existing if it were perfectly predictable. So this video isn't about timing the crash down to a specific date. It's about recognizing the conditions that historically come before major downturns so you can make smarter decisions with your own money. Let's start with the first sign: overconfidence and detachment from reality. Every major crash in modern history has been preceded by a period where people stopped asking whether an asset was actually worth what they were paying for it, and just assumed it would keep going up forever. In Japan in the late 1980s, land prices had climbed so far beyond what any reasonable calculation could justify that some estimates suggested the ground beneath the imperial palace was worth more than all of California. People genuinely believed the market there couldn't fall. In the late 1990s, companies with no revenue and no profits were being valued at billions of dollars simply because they had a website and a compelling story. And then in the mid-2000s, the belief that real estate never goes down at a national level became so deeply embedded in the culture that banks stopped even asking borrowers for proof of income. Every single one of those unshakable beliefs eventually shattered. Today you can hear echoes of the same kind of certainty around certain technology sectors, artificial intelligence, and a handful of mega-cap stocks. When the narrative shifts from this company creates real value to this sector can't possibly lose, that's your first warning sign. The second sign is unchecked leverage. This is the one that turns a market correction into a full-blown collapse. When people and institutions are borrowing heavily to invest, losses don't just hurt, they cascade. The dot-com crash wasn't just about overvalued tech stocks. Telecom companies had borrowed billions to build infrastructure they believed would be needed for decades of uninterrupted growth. When that growth didn't materialize, all that debt became a crushing anchor. In 2008, the problem wasn't just that housing prices fell, it was that the entire financial system had layered debt on top of debt through complex mortgage-backed securities, and when defaults started rising, the losses rippled outward into every corner of the global economy. Right now, corporate debt is sitting at historically high levels. Consumer credit card balances are breaking records, and certain speculative corners of the market are heavily funded with borrowed money. High leverage doesn't cause crashes, but it makes them dramatically worse. The third sign is regulatory blind spots and financial engineering that outpaces oversight. In the years leading up to 2008, mortgage-backed securities were being stamped with top safety ratings even though the underlying loans were extraordinarily risky. The financial products had grown so complex that even the people selling them didn't fully understand what was inside them. And regulators, either overwhelmed or under-resourced, were not keeping pace. Today you can see similar dynamics playing out in areas like private credit markets, certain corners of financial technology, and newer asset classes where growth is happening faster than the guardrails around it. The fourth sign is a sudden shift in sentiment. This one is the most powerful and the most unpredictable. Crashes don't just happen because numbers get too high. They happen because belief cracks. And when it cracks, it can move shockingly fast. In 2008, the decline wasn't literally overnight, but the collapse of confidence happened within a compressed window of months that felt sudden to most people living through it. What many describe as a 50% drop feels sudden even when it unfolds across months, because by the time most investors react, the damage is already deep. Today we're in an environment where a single earnings miss, a policy announcement, or a geopolitical development can wipe billions off valuations within hours. That fragility in sentiment is itself a warning sign. Now here's something worth addressing directly. You might be thinking that every year there are 100 videos predicting a crash, and most of them are wrong. You are completely right. And if you have been sitting on the sidelines waiting for the sky to fall, there is a massive cost to that. Missing years of compound growth while waiting for a collapse can be just as damaging to your financial future as getting caught in the crash itself. The point of understanding these warning signs is not to stop investing. It is to invest more intelligently. If you want to protect your money and actually come out ahead, you need to build your crash playbook today. Here are the 4 specific moves you need to make right now. First, build an opportunity fund. This is entirely separate from your emergency savings. This is a pile of cash sitting in a high-yield savings account waiting to be deployed. When a crash hits, most people panic because they are fully invested and have no cash left to buy the dip. If you have an opportunity fund ready to go, a market crash stops being a crisis and becomes the greatest wealth-building event of your life. You get to buy premium assets on clearance. Second, stress test your diversification. A lot of people think they are diversified because they own 20 different stocks. But if those are all software and tech companies, you are not diversified at all. You just own 20 versions of the exact same risk. True wealth protection means owning different types of assets that do not move in the exact same direction. Look at your portfolio today and ask yourself a hard question. If the stock market drops 30% tomorrow, what do I own that will actually hold its ground? Third, ruthlessly eliminate your high-interest debt. Think of credit card debt like a financial leak. When the economy is booming, you might not notice it. But during a market slowdown, that leak will sink your ship. Paying off a credit card with a 20% interest rate is a guaranteed 20% return on your money. There is no stock market investment in the world that can guarantee you those numbers. Lock that win in right now. Finally, write down your exact buying strategy while your head is still clear. What specific index funds or companies are you going to buy if the market drops 20%? What about 30%? Write it down on a physical piece of paper and put it on your desk. The investors who build generational wealth during crashes do not have a crystal ball. They just make their decisions before the chaos starts, and they execute that plan mechanically, while everyone else is letting fear run the show. The 4 patterns we have looked at today, overconfidence, excessive leverage, regulatory blind spots, and fragile sentiment, have shown up before every major crash of the last 50 years. They are not guarantees of an imminent collapse tomorrow, but they are the conditions under which a tiny spark can ignite a massive fire. Knowing that does not make you pessimistic. It makes you prepared. So here's what I want to ask you, and I genuinely want to hear your thinking on this. Looking at these 4 warning signs, which one do you think poses the biggest risk in today's market and why? Drop your answer below. There is no right or wrong response here, just real conversations about something that actually matters for your financial future. If you found value in this video, please click the like button and subscribe to the channel for more financial insights. See you in the next one.